Okay, let's unpack this. Today, we're diving deep into the metals company, ticker TMC.NS. It's not just a stock, it's really a fascinating intersection of finance, this whole new deep sea mining industry, and, well, the powerful currents of environmental regulation. We've got a detailed trading report here from Jin Log, a seasoned trader's deep dive, no less. And our goal today is to pull out the truly important insights, giving you a real shortcut to understanding TMC inside and out.
What's truly fascinating here is how the source material, this detailed trading report titled The Metals Company, Trading the Double Top Breakdown, it manages to weave together such precise technical chart analysis with these broader, almost philosophical contextual factors.
Right.
We're not just talking about company financing or, market sentiment. We're delving into ongoing regulatory hurdles, complex geopolitical dynamics, and even profound public opinion.
Yeah.
We'll be exploring not just what the market is doing with TMC, but why it matters on a much larger scale, and the so what for anyone interested in this frontier industry that could, well, redefine global resource extraction.
Indeed, it really paints a comprehensive, almost dizzying picture of both opportunity and, well, immense challenge. So let's begin by getting a clear snapshot of the metals company itself, this pioneer in a field that's still very much taking its first, cautious steps. So the metals company, ticker TMC.NAS, currently trades around $7.07, and it boasts a market capitalization of approximately $3.0 billion.
$3 billion.
Yeah. Now, for a company in what we're calling a nascent pre-commercial industry like deep sea mining, a $3 billion market cap is pretty substantial.
It really is.
When I first saw that number for a company still largely in R&D and facing so many unknowns, my jaw nearly hit the floor. It's clear some serious smart money believes in this. For you, the curious learner, this means understanding a company that, while it's substantial in its valuation, is operating in a field fraught with both massive transformative potential and significant, often unpredictable unknowns. It's a bit like betting on a startup building a spaceship thrilling, but with immense risk and, a long journey ahead before it even leaves the launch pad.
That market cap absolutely highlights the high conviction, almost frontier-like nature of investments in this sector. It suggests that a significant segment of the market isn't just speculating. They believe deeply in the long-term viability and, well, the eventual necessity of deep-sea mining, despite the inherent risks of developing an entirely new industry from scratch.
Right, from scratch.
We're talking about a company that aims to extract polymetallic nodules from the abyssal plains. These potato-sized rocks, rich in nickel, copper, cobalt, and manganese, critical for the green energy transition.
The battery metals.
Exactly. This isn't just some small-cap speculative play based on a whim. It's a company that has already attracted and deployed substantial capital, which immediately elevates its importance in the broader global resource landscape. However, that high conviction needs to be constantly reevaluated, especially when fundamental market psychology, reflected in technical signals, starts to flash serious warnings.
And speaking of warnings, the Jin Log report immediately flags a classic bearish signal. The double top breakdown.
Double top.
They pinpointed this pattern clearly forming on April 1st and again on May 20, which then led to significant selling pressure. I've heard traders talk about double tops with almost reverence, like it's a crystal ball.
Chuckles slightly. Well, not quite a crystal ball, but...
For those of us still learning the ropes, can you break down what exactly a double top signifies in technical analysis? And is it truly as potent a signal as it's made out to be? What makes it such a high-risk reversal zone?
Precisely. A double top is one of the most recognized and often reliable reversal patterns in technical analysis. Imagine a climber attempting to summit a mountain peak.
Okay.
They reach a certain altitude, get tired, and retreat. Then they gather their strength and attempt to reach that exact same peak again, but they fail a second time, falling back more decisively.
I see.
On a price chart, this looks like two distinct peaks at approximately the same price level, separated by a noticeable dip or trough. The psychology behind it is crucial. Buyers twice tried and twice failed to push the price past a certain resistance level.
So buying exhaustion.
Exactly. This double failure signals that the upward momentum is truly exhausting itself, and that sellers are gaining confidence, stepping in strongly to push the price down. It becomes a high-risk reversal zone, precisely because it often precedes a substantial and rapid price decline, marking a definitive shift from bullish to bearish sentiment.
Okay.
For TMC, those specific dates, April 1st and May 20, are crucial because they pinpoint the exact moment this market psychology played out for the company, setting the stage for the selling pressure we've seen. It's not just a pattern. It's, a psychological battle visible on the chart.
Right.
The real insight here, for you, is that this isn't just a small blip. It's the market signaling a deep-seated loss of confidence, often leading to a much more dramatic fall than many initially expect. It's like watching a high-stakes poker game where one player just lost their nerve twice in a row.
So once that breakdown occurs and the market starts to reevaluate, the natural question becomes, where does the price go next? The report identifies two key price levels to watch very closely. Swing level support at $6.24, and it warns of a deeper breakdown towards $4. What do these specific numbers signify for someone trying to understand TMC's potential market behavior and how the current selling pressure might play out?
These aren't just arbitrary numbers on a chart. They are critical thresholds that chartists and traders pay immense attention to. Swing level support at $6.24 is a price point where, historically, strong buying interest has previously stepped in to halt the decline and push the price back up.
Okay, like a previous floor.
Exactly. Think of it as a previous battleground where buyers successfully defended their ground. It acts as a potential bounce-off point, a floor where sellers might encounter strong resistance from buyers once again. It's the first major test for the current selling pressure triggered by the double-top breakdown.
It's the first line of defense.
Precisely. If the price holds at $6.24, it suggests a potential temporary reprieve or even a short-term rebound.
Yeah.
However, the report also issues a stark warning of a deeper breakdown toward $4.
Right.
This signifies that if the initial support at $6.24 fails to hold, if buyers don't step in with enough force, a more significant and potentially rapid correction is anticipated. The $4 level could represent a strong psychological threshold, another deeper historical support level, or a structural level where a much larger pool of long-term buyers or institutional money might be waiting to accumulate shares.
Okay, so really crucial levels.
Very much so. For you, tracking these levels is vital because they could dictate how quickly or dramatically TMC's valuation adjusts in the near term, giving you concrete markers to monitor its market behavior and potential future trajectory. It's about anticipating where the market might find its next equilibrium, even if just temporarily.
That brings up a critical point. While market sentiment paints a vivid picture on the charts, a company's fundamental financial health ultimately underpins its long-term viability.
Absolutely fundamental.
After all, even the best chart pattern can't save a company that's run out of cash. So let's pull back from the candlesticks and dive into the metals company's financial health. The report highlights that TMC recorded a net loss of $81.9 million in 2024 and another $21 million in Q1 2025.
Substantial figures.
Yeah, these substantial losses are explicitly attributed to ongoing exploration spending and seasonal R&D outlays. For many, seeing large, consistent losses might immediately raise red flags and cause concern. But is this always a bad sign, particularly for a company like TMC operating at the very, bleeding edge of a new industry?
That's a crucial distinction, and it goes right to the heart of understanding growth industries. While consistent losses in a mature established company, say, an airline or a traditional manufacturer, might signal operational inefficiencies, declining demand, or severe market competition.
Right, signs of trouble.
Exactly. But for companies in early-stage, capital-intensive industries like deep-sea mining, such losses are not just typical, they are largely expected. These aren't necessarily signs of distress, but rather massive investments, truly foundational investments in future infrastructure, extensive research, and complex development necessary to establish an entirely new industry.
So spending money to make money, eventually.
Precisely. Think of it as a prolonged upfront cost for building something that has never existed before on a commercial scale. TMC isn't merely building a factory. They're literally building the very blueprint and technology for how an industry will operate in the deep ocean, often in extreme conditions.
That's a good way to put it.
The $81.9 million loss in 2024 and $21 million in Q1 2025 reflect the staggering cost of developing sophisticated deep-sea robotic systems, conducting extensive environmental impact assessments in unexplored territories, and navigating a labyrinth of international regulations.
Okay.
The long-term implication of these sustained losses, however, is clear. It suggests a long journey to profitability, making strategic financing not just important, but absolutely crucial for their survival and the continued development of this pioneering technology. They need a deep war chest to sustain operations until commercialization becomes viable.
So that begs the question, how is a company burning through this much cash sustaining itself, especially when commercial revenues are still, a distant prospect? The report points to some significant strategic financing moves. TMC secured $37 million on May 12, followed by a substantial $85.2 million stake purchase by Korea Zinc.
Yes, Korea Zinc.
This totals $122.2 million in fresh capital, and the report notes this provides ample runway. Can you elaborate on the significance of this capital infusion and particularly the nature of the Korea Zinc investment?
This $122.2 million in fresh capital is nothing short of a lifeline, particularly for a company in its pre-revenue phase, where cash burn is the norm. To break it down, the $37 million raise on May 12 was likely a general capital injection, potentially from existing investors or new institutional buyers, common for growing companies needing to fund ongoing operations.
Okay, standard stuff.
Pretty standard, yeah. However, the $85.2 million stake purchase by Korea Zinc is in a different league entirely, and it carries much deeper implications. This isn't just a generic investor. Korea Zinc is one of the world's largest zinc, lead, and precious metals refiners, a true behemoth in the global metals industry.
A major player.
A very major player. Their investment is what we call a strategic partnership, implying far more than just a cash infusion. The term ample runway means TMC now has sufficient cash reserves to cover its operating expenses, continue its extensive R&D, and push forward with development costs for an extended period, potentially 12 to 18 months or even longer, depending on their burn rate, without immediately needing to raise more funds.
Buying them crucial time.
Absolutely crucial time. This period is vital for them to achieve key operational and regulatory milestones without the constant pressure of capital raising.
That's intriguing. The Korea Zinc investment in particular seems to carry deeper significance beyond just the cash, as you mentioned. How does such a strategic partnership fundamentally strengthen TMC's balance sheet and, perhaps more importantly, reduce its overall funding risk in the eyes of a market?
Precisely. A strategic investor like Korea Zinc stepping in isn't merely a source of capital, it's a powerful vote of confidence in TMC's technology, its market potential, and its long-term vision.
A big stamp of approval.
A very big one. Such partnerships often open critical doors. They can provide access to new markets for the future metals, offer specialized refining expertise that TMC might need down the line, or even create operational efficiencies through collaborative R&D that would otherwise be difficult to achieve.
Right. Tangible benefits beyond cash.
Absolutely. For instance, Korea Zinc's deep experience in metal processing could be invaluable for TMC as it moves towards commercial-scale refining of polymetallic nodules. How does it reduce funding risk? By bringing in a stable, significant chunk of capital and potentially signaling future support or even off-take agreements.
Off-take agreements, yeah.
Makes TMC a far more attractive prospect to other investors and lenders. It acts as a powerful third-party validation of the business model and technology to the broader financial community, implying that if a major established industry player like Korea Zinc sees tangible value and future potential, then other investors might too, potentially making future capital raises easier and cheaper for TMC. For you, this partnership could be a crucial validation point for TMC, suggesting that established industrial giants see deep-sea mining as a serious, viable, and potentially lucrative long-term play. It signals that this isn't just a dream, it's a developing reality with serious backing.
And looking ahead, the report notes that Q2 2025 earnings for TMC are scheduled for August 13th, with a consensus EPS earnings per share of negative $0.06.
Negative 6 cents.
Right. Why are these upcoming earnings reports so critical for a public company, even one that's still in its heavy investment phase and reporting losses? What exactly is the market looking for here?
Upcoming earnings reports are always critical for public companies because they provide the market with the most updated official financial snapshot, offering a glimpse into the company's operational health and future outlook. Consensus EPS is the average estimate of what financial analysts who cover the company expect it to report.
The street's expectation.
Exactly. While we know TMC is in a loss-making phase due to its heavy investment in R&D and exploration, the market is scrutinizing not just the absolute loss, but how that loss compares to these expectations.
Beat or miss.
Precisely. If their actual loss is much higher than the consensus, it could signal unforeseen cost overruns, operational inefficiencies, or unexpected delays in their development roadmap, potentially leading to negative sentiment and a further sell-off.
Okay.
Conversely, if they report a smaller loss than expected, or provide positive updates on project milestones, perhaps progress on pilot plant development, or initial results from nodule collection tests within the earnings report, it could be viewed very favorably by investors.
So forward-looking statements matter too.
Immensely. It's not just about the numbers themselves, but how they align with or deviate from market expectations, and crucially, what guidance the company provides for the future development of its projects. It's a key checkpoint for investor confidence.
So, while financial health and strategic partnerships are undoubtedly key, the entire viability of this nascent industry, and TMC by extension, ultimately rests on much larger external factors, critical regulatory approvals, and profound environmental considerations.
Yeah, these are the really big ones.
These are the truly high-stakes elements. This brings us to a major bottleneck that could make or break TMC. Deep-sea mining permits remain in regulatory limbo under ISA guidelines.
Regulatory limbo, yeah.
Can you elaborate on what regulatory limbo truly means in this context and the pivotal role of the International Seabed Authority? What makes it so difficult to get clear guidelines, and what are the implications of this prolonged uncertainty?
Regulatory limbo is a state of profound, frankly paralyzing uncertainty. It signifies that a clear, comprehensive, and universally agreed upon legal and operational framework for commercial deep-sea mining, including critical aspects like environmental regulations, financial terms, and production limits, is simply not yet finalized or adopted.
So no clear rules of the road.
Exactly. This uncertainty directly prevents full-scale commercialization for companies like TMC, as they can't undertake the massive investments required for extraction without knowing the definitive rules of engagement. The International Seabed Authority, or IDAS, is the global body established under the United Nations Convention of the Law of the Sea, UNCLOS.
The ISA, right?
Its mandate is incredibly complex: to organize and control all mineral-related activities in the international seabed area, which lies beyond the limits of national jurisdiction, essentially covering roughly half of the Earth's ocean floor. Their role is absolutely pivotal, as they are tasked with balancing the need for resource extraction with the protection of the marine environment, all while upholding the principle that these resources are the common heritage of mankind.
A tough balancing act.
Extremely tough.
Yeah.
What makes it so difficult to finalize these guidelines? Several factors. You have competing national interest nations with deep-sea mining aspirations versus those prioritizing environmental protection. There's a persistent lack of complete scientific consensus on the long-term environmental impacts of deep-sea mining, making it hard to set universally accepted standards.
Science isn't settled.
Not entirely, no.
Yeah.
And then there's the philosophical debate around the common heritage of mankind principle. How should the benefits of deep-sea mining be shared globally? The fact that clear, comprehensive guidelines from the ISA are still pending is a massive bottleneck.
A real logjam.
It means companies like TMC can conduct exploration, develop technology, and even run pilot tests, but they cannot proceed with large-scale commercial extraction because the rules of the game haven't been fully defined, debated, and adopted by a truly international body. This prolonged limbo translates directly into delayed revenue generation, ongoing substantial expenses, and a cloud of uncertainty that significantly impacts the long-term viability and investor confidence.
Right.
It's a fundamental hurdle that affects the entire nascent industry, and every month of delay adds to the financial burden and the inherent risk.
And this regulatory uncertainty is powerfully compounded by significant environmental pressure. The UN and various non-governmental organizations are actively calling for a moratorium on deep-sea mining, which the report states poses a timeline uncertainty for the industry.
Moratorium calls.
What are the core scientific and ethical concerns driving this widespread opposition, and what would a moratorium, a complete halt, mean for the future of TMC?
The core concerns of environmental groups and the UN are both profound and multifaceted, stemming from genuine scientific uncertainty and deeply held ethical values. Firstly, there's the potential for irreparable damage to unique deep-sea ecosystems.
Delicate environments.
Extremely delicate. These environments, often characterized by extreme pressure, darkness, and cold, host highly specialized and slow-growing life forms, many of which are still being discovered by scientists. There's a significant fear that mining activities, which involve scraping or vacuuming the seabed, could cause widespread and long-lasting disruption to biodiversity on a massive scale.
Okay.
Concerns include sediment plumes, smothering filter feeders and other organisms over vast areas, noise pollution impacting marine mammals and other deep-sea fauna, and the direct destruction of fragile seabed communities that might take thousands of years, if ever, to recover.
Potentially irreversible damage.
That's the fear. Beyond direct impact, there are unknown long-term implications for global ocean processes, including nutrient cycling and carbon sequestration. Environmentally, scientists emphasize the irreversible nature of damage to these pristine, slow-recovering habitats. Ethically, the debate centers on whether humanity has the right to exploit these remote, globally significant ecosystems, especially when the full extent of their ecological importance and potential risks are not yet fully understood.
A really fundamental question.
It is. A moratorium, in this context, means a temporary halt or complete ban on deep-sea mining activities until comprehensive scientific studies can be completed and robust, legally binding environmental regulations are in place. For TMC, a moratorium would be devastating.
Yeah, catastrophic.
It would mean their massive investments in exploration, technology development, and pilot programs could not translate into commercial operations for an indefinite period, potentially pushing their timeline indefinitely or even permanently restricting their ability to mine the seabed. This public and institutional pressure adds an immense layer of unpredictable risk to TMC's operations, transforming it from a purely financial venture into a global ethical debate about resource extraction versus environmental stewardship. It's a challenge that goes far beyond just securing permits. It's about securing a social license to operate, which is arguably even more complex to navigate than regulatory frameworks.
It's a stark contrast then, isn't it? Because despite this global limbo and opposition, the report highlights that U.S. permitting for deep-sea mining has actually accelerated under recent executive actions.
Yeah, that's a fascinating divergence.
How does this create such a fragmented and complex regulatory landscape where different nations seem to be pulling in different directions, and what are the potential reasons behind the U.S. acceleration?
It creates a truly fascinating and indeed fragmented global regulatory landscape, highlighting the geopolitical complexities of resource extraction. On one hand, you have the ISA struggling to finalize a global framework amidst strong calls for a moratorium from the UN and NGOs.
Right, the global picture.
On the other, the U.S. appears to be forging ahead, streamlining its domestic permitting processes. The potential reasons for this acceleration in the U.S. are likely multi-layered and strategic. One significant factor could be strategic mineral independence.
Securing critical minerals.
Exactly. The U.S., like many industrialized nations, relies heavily on foreign sources for critical minerals, like the nickel, cobalt, and manganese found in deep-sea nodules, which are essential for electric vehicles, renewable energy infrastructure, and defense technologies. As global supply chains become increasingly complex and geopolitically sensitive, with concentration of production in a few countries, the U.S. might view deep-sea sources as a crucial pathway to secure domestic supply and reduce reliance on potentially unstable foreign sources.
Makes strategic sense.
It does. Economic incentives also play a role, with the potential for new jobs, technological innovation, and the creation of a pioneering industry. Furthermore, the U.S. might have a different assessment of the environmental risks, or believe that with proper technological safeguards and robust monitoring, mining can be conducted responsibly.
A different calculation, perhaps.
Perhaps. This creates a situation where different nations might adopt varying stances, some pushing for extraction, others advocating caution or outright bans. For TMC, which aims to operate in international waters under ISA jurisdiction, this fragmentation means navigating a complex patchwork of regulations, geopolitical interests, and varying public perceptions, adding yet another profound layer of complexity to their path forward.
Wow.
It means their viability is not just about one set of rules, but about navigating a constantly shifting global dynamic.
It's abundantly clear there are massive external pressures, both regulatory and societal, on this company and indeed the entire industry. So how does a sophisticated trading strategy attempt to make sense of and perhaps even profit from such a volatile and uncertain situation? This is where Jin Log's method comes in, aiming for precision amidst the noise. The report introduces the VPAR Rhythm Trading Method, described as focusing on identifying highest impact news and events, coinciding with key support pivot points to manage risk while chasing optimal returns, all while rigorously avoiding overtrading.
Overtrading, the bane of many traders.
It emphasizes combining sector-wide context with live index monitoring. This sounds like a very disciplined, almost Zen-like approach to the market. Can you break down the core philosophy here for us?
You're right, it is incredibly disciplined, and it's a refreshing approach in a world flooded with information. The core philosophy of the VPAR Rhythm Trading Method is to cut through the relentless noise. In a market where there's endless news and events, tweets, headlines, analyst upgrades, downgrades, it's incredibly easy to get overwhelmed, react impulsively, and make emotional decisions.
Yeah, chasing headlines.
Leading to overtrading, which, as the report wisely states, erodes both capital and time. Instead, Jin Log, your top trader, advocates for a highly selective and patient focus, identifying only the highest impact events, the ones truly capable of moving the market significantly and sustainably, and then waiting for those critical events to align with key support pivot points on the price chart.
Timing the entry.
Precisely. These pivot points are not just random numbers. They are critical price levels where trends might reverse, offering high probability entry or exit points because they represent previous areas of strong buying or selling interest. The genius of this method lies in its comprehensive approach, combining this specific stock analysis with broader, sector-wide context and live index monitoring.
Looking at the bigger picture.
Exactly. This allows traders to differentiate between an isolated stock movement, say TMC having a bad day, and broader market trends, for example, the entire deep-sea mining sector facing headwinds, or even the broader stock market undergoing a correction. This holistic view is crucial for effective risk management and ensuring you're chasing optimal returns rather than just chasing hype or reacting to fleeting news.
Makes sense.
It emphasizes patience, strategic entry, and risk mitigation over reactive, impulsive trading, making it a very methodical and thoughtful approach for you, the discerning investor who wants to trade with conviction, not just emotion.
So let's look at how this plays out on the daily chart for TMC.NAS. The report explicitly states the classic double top from April 1 and May 20 is clear on the daily chart, and it identifies key re-entry pivots at the swing support, $6.24, and swing pivot, $4.
Those key levels again.
It also stresses confirming trend, rhythm, and flow signals across your time frames. How does Jin Log use this daily chart to visualize these key elements? And what does confirming across time frames mean for a trader's strategy?
The daily chart is the primary canvas where the VPAR method truly comes alive for TMC. The classic double top at April 1 and May 20 is not just a theoretical pattern. It's a distinct visual cue on the chart, two peaks at roughly the same height, a valley in between that loudly signals a powerful shift in momentum.
You can really see it.
You can literally see buyers failing twice at the same price ceiling, which then unleashes the selling pressure we discussed. The key re-entry pivots at $6.24 swing support and $4 swing pivot are identified visually on this chart as areas where buying interest has historically emerged or is strongly anticipated to emerge again, potentially halting the current decline.
Potential bounce zones.
Potential bounce zones, exactly. These are opportune price levels where a trader might consider reestablishing a long position after a significant decline if the conditions align with Jin Log's methodology. And the emphasis on confirming trend, rhythm, and flow signals across your timeframes is absolutely paramount.
Why is that so critical?
It means not just looking at the daily chart in isolation. A short-term trend might appear sharply bearish on a 15-minute chart, showing immediate selling pressure. However, simultaneously, on a weekly or monthly chart, the long-term trend could still be strongly bullish, reflecting the underlying conviction in TMC's future.
Different perspectives.
Completely. This multi-time frame analysis allows a trader to understand the immediate market noise, the short-term fluctuations within the context of the larger, more significant trends. It's like looking at a ripple in a pond, but knowing the underlying current is still moving powerfully in one direction.
Got it.
This prevents you from making a short-term trade based on a long-term signal, or vice versa, ensuring your actions align with the prevailing market rhythm relevant to your trading horizon. It's about seeing the whole picture, not just a snapshot.
That brings us directly to rhythm analysis, which the report breaks down into three critical perspectives: short-term, swing, and mid-term. Let's delve into each. What does it mean for the short-term rhythm to be transitioning from expansion into initial consolidation, currently in the expansion formation phase post-breakout?
Okay, so in rhythm analysis, expansion typically refers to a period of strong directional price movement, often characterized by increasing volatility and a clear, sustained trend.
Like the move down after the double top.
It's exactly. The report notes TMC is transitioning from expansion into initial consolidation, currently in the expansion formation phase post-breakout. This means that after the sharp directional move downwards, the breakout from the double top, which was an expansion of bearish momentum, the immediate frantic selling pressure might be easing. Consolidation suggests a period where the price is stabilizing or moving sideways after that sharp decline.
Catching its breath.
Precisely. It indicates that the market is taking a breath, perhaps forming a base or gathering energy for its next significant move. For short-term traders, this phase is crucial because it often precedes either a continuation of the prior trend, meaning more downside, or, more optimistically, a potential reversal. It's a period of potential setup for future moves, rather than strong directional conviction in the immediate moment.
Okay.
It's the market processing the shock and finding its temporary footing.
Okay, so a short-term pause or stabilization. What about the swing rhythm? It's described as accelerating above the bands, then rolling over into a down-to-up transition pattern. This sounds quite specific and hints at a potential change in the intermediate trend.
It is, and it offers more context for the medium-term price cycles, which typically span a few days to a few weeks. When the price accelerates above the bands, picture it like a river suddenly overflowing its banks.
Mhm.
Those bands represent the normal slow channel of the stock price, often something like Bollinger Bands.
Right, Bollinger Bands.
When the price accelerates above them, it means the market is experiencing extreme, often unsustainable upward energy bursting outside its usual boundaries. Then it starts rolling over. The river's surge is dying down, and the water is receding, indicating a loss of that upward momentum and a shift in direction.
Losing steam.
Exactly. The crucial part here for swing traders is the down-to-up transition pattern. This signals a potential shift from a corrective downward phase to a new impulsive upward phase within the swing time frame.
A potential reversal point.
A potential reversal point, yes. For traders operating on a medium-term horizon, this transition is extremely important because it offers potential opportunities for reversal trades, catching the beginning of a new upward swing after a corrective move. It suggests the previous downward swing might be losing its steam, and new buying interest could be emerging as the market identifies the correction as complete on this time frame.
And finally, the midterm rhythm. This is described as sustained expansion, with bands widening alongside strong upward momentum. This seems to contradict the short-term and swing analyses to some extent, suggesting a deeper underlying strength.
It does seem contradictory at first glance, yeah.
What's the significance here, and why is this such a crucial counterpoint for long-term investors?
This is indeed a crucial counterpoint, and it highlights the power and necessity of multi-time frame analysis. While the short-term rhythm indicates immediate consolidation and the swing rhythm suggests a potential transition after a down move, the midterm rhythm for TMC remains strongly bullish.
Bullish, even after the drop.
On the midterm time frame, yes. Sustained expansion in this context means there's an underlying powerful trend pushing the price higher over a longer period, typically weeks to months. Bands widening in this context signifies increasing volatility and strength in that prevailing upward trend, indicating a robust directional movement.
Okay.
This suggests that despite the recent double-top breakdown and short-term selling pressure, the long-term investors, often larger institutions with deeper pockets and longer investment horizons, still see significant upward potential in TMC. It tells you that the current downward pressure might simply be a corrective phase within a larger, more powerful uptrend.
A correction within an uptrend.
Potentially, yes. For long-term investors, this midterm strength is what they're paying attention to, suggesting that any significant pullback or dip, like the one triggered by the double top, could be viewed as an opportune moment to accumulate shares within that larger, powerful upward trajectory. It's a message that the foundational belief in the company's future is still intact.
That makes perfect sense, seeing the forest despite the immediate trees. So how does Jin Log translate these rhythm analyses and the presence of these key support levels into concrete strategic entry scenarios? The general principle is to wait for initial rhythm formation and order flow stabilization before scaling in after a trendline break. What does scaling in mean, and why is this such a disciplined approach, especially for a volatile stock like TMC?
Scaling in means gradually accumulating a position over time, rather than making one large lump sum purchase.
Not going all in at once.
Exactly. Instead of buying all your desired shares at once, you might buy a quarter of them today, another quarter if the price drops to a specific level, and then a final portion if it shows clear signs of reversal. This is a hallmark of a cautious, methodical approach to investing, as it effectively spreads out the risk associated with trying to perfectly time the market.
Reduces timing risk.
Precisely. It acknowledges that after a trendline break, like the double top breakdown, the market can be incredibly volatile and unpredictable. So the strategy is to wait for initial rhythm formation and order flow stabilization. This means waiting for the immediate chaos to settle, for clear patterns to emerge on the chart, and for buying or selling, volume, order flow, to show a clear direction and commitment before committing significant capital.
Patience and confirmation.
Exactly. It's about patience and confirmation, not chasing a falling knife or reacting impulsively. This disciplined approach is crucial for a stock like TMC, where external factors can cause rapid and unexpected price swings.
And the report provides specific, almost surgical conditions for different entry scenarios depending on your time frame. For a short-term buy, the entry zone is post-break rhythm stabilization with conditions like trap resolution, 13 plus early expansion signal plus order flow pickup. Can you decode these technical terms for us and explain what a trader is looking for here?
Absolutely. This strategy aims to capture a very early rebound after the initial shock of the breakdown, almost like catching a falling leaf just as it starts to float up again.
Chuckles. Okay.
Post-break rhythm stabilization means we're waiting for that immediate volatility and panic to subside, and for some form of price stability to emerge after the double top broke down. Now, the technical terms. Trap resolution 13 sounds complex. But think of it this way. When the price falls sharply, some buyers who bought higher get trapped in losing positions.
Bag holders.
Right, and their eventual selling often adds to the downward pressure. This signal tells us that at least a third of that downward pressure, from those trapped sellers finally giving up or new buyers stepping in, has been absorbed. It's like the market taking a deep breath and exhaling some of the fear.
Okay, absorbing the selling.
Exactly. Coupled with an early expansion signal, which would be the very nascent faint twitch of upward momentum beginning to build again, perhaps on a very short time frame like a 15-minute chart, and order flow pickup, which means actual significant buying volume starting to come into the stock. It gives us a higher probability setup.
Putting the pieces together.
Yes. We're looking for the market to stop panicking and show the first tiny but confirmed hints of renewed interest, signaling that the initial shock has passed and a short-term bounce is becoming more probable. It's about being nimble and catching the very first signs of a shift.
Okay, moving to the swing buy. This targets the previously identified, more significant support at $6.24, with conditions like trap resolution 23 plus rhythm reversal plus flow confirmation. How does this strategy differ from the short-term approach, and what level of conviction do these conditions provide?
The swing buy at $6.24 targets a more established and potentially more reliable bounce point compared to the short-term entry. This strategy is for traders looking to capitalize on medium-term price movements, typically lasting a few days to a few weeks after a more substantial correction.
A bigger move potential.
Potentially, yes. The condition trap resolution 23 implies a more significant portion of the correction has been completed compared to the short-term entry. This means a deeper, more substantial absorption of selling pressure, indicating that the majority of trapped sellers have likely exited or that new, more significant buying interest has emerged. This offers a higher probability setup for a more sustained medium-term rebound.
More confirmation.
More confirmation. Rhythm reversal ties directly back to our earlier discussion of the swing rhythm down-to-up transition pattern. It means the price action is showing clear and confirmed signs of changing direction from a downtrend to an uptrend on the swing time frame. And flow confirmation again indicates sustained, significant buying pressure at this critical $6.24 support level, validating the technical pattern with actual capital inflows.
Got it.
This strategy demands more patience, waiting for clearer signs of a directional shift, but it aims for a more substantial move than the short-term bounce. It's about waiting for the market to give a more definitive nod that the correction is truly winding down.
And then there's the midterm buy, with an entry zone at $3.50 and conditions of rhythm expansion plus institutional flow acceleration. This is targeting a much deeper potential pullback, suggesting a long-term conviction play.
That's the deep value play potential.
What exactly does institutional flow acceleration tell us about the market's bigger players?
This midterm buy at $3.50 is the most cautious and long-term oriented strategy Jin Log outlines, targeting the deepest potential pullback and representing a conviction buy for long-term investors. The entry zone, $3.50, aligns with the previously identified deeper swing pivot, implying that if the $6.24 support fails, this is the next significant structural level where major buying interest is anticipated.
The last line of defense, maybe?
Perhaps. The condition rhythm expansion here would mean a powerful, confirmed shift to an upward trend on the midterm timeframe, indicating strong directional movement once again, potentially signaling the start of a new, sustained uptrend. But what makes this entry particularly compelling, and what truly sets it apart for long-term investors, is institutional flow acceleration.
The big money moving in.
Exactly. This is key. It signifies that large, sophisticated investors, think pension funds, major hedge funds, mutual funds, and endowments, are significantly increasing their buying activity. Institutional flow is often a powerful bullish signal for a long-term trend because these players typically have extensive research capabilities, conduct deep due diligence, and take large, conviction-based positions that move markets.
Right.
Their accumulation of shares suggests they see compelling long-term value in future catalysts, even after a substantial price correction, providing a powerful validation for a potential long-term upward move. For you, this indicates that the smart money, the big players who do their homework, is starting to move in, which is a strong vote of confidence for the company's long-term prospects.
Jin Log's analysis also incorporates Elliott wave analysis, another complex but powerful technical tool.
Elliott wave. Gets complex.
It mentions that short-term, completed wave 3 at the double top, wave 4 correction underway, watch for trap 23 near support. And crucially for the midterm, wave 5 extension expected if deep-sea mining catalysts accelerate. Can you briefly explain Elliott wave theory and how it applies here, particularly in connecting a highly technical wave 5 prediction to fundamental external catalysts like regulatory breakthroughs?
Okay, briefly. Elliott wave theory is a fascinating and often complex fractal market analysis tool developed by Ralph Nelson Elliott. In essence, it posits that price movements in financial markets occur in predictable, repetitive patterns or waves, which are driven by recurring investor psychology.
Market psychology patterns.
Exactly. These patterns typically consist of a 5-wave impulse sequence in the direction of the larger trend, waves 1, 2, 3, 4, 5, followed by a 3-wave corrective sequence against it, waves A, B, C. Wave 3 is typically the strongest and longest impulsive move in a trend, representing widespread conviction. So its completion at the double top for TMC makes perfect sense. It marks the peak of that powerful upward drive before the exhaustion set in.
Okay, peak enthusiasm.
Right. The subsequent wave 4 correction underway is the natural pullback after such a strong impulse, aligning perfectly with TMC's recent downtrend and reflecting a period of profit-taking and consolidation. This corrective wave is where the trap 23 near support comes into play, referring to the point where the correction has sufficiently exhausted sellers and buying interest starts to emerge.
Finding the bottom of the correction.
Potentially. What's truly compelling here, and a hallmark of sophisticated analysis, is how Jin Log links the highly technical prediction of a midterm, wave 5 extension, to fundamental external factors. A wave 5 extension is a highly bullish scenario, representing a powerful continuation of the uptrend beyond typical expectations, often indicating a final surge of investor excitement.
A big final push upwards.
Exactly. But it is explicitly contingent on deep-sea mining catalysts accelerating. This directly connects the technical prediction to real-world fundamental and regulatory breakthroughs, specifically the resolution of those regulatory limbo issues from the ISA and the overcoming of environmental opposition we discussed earlier.
So the waves depend on real-world events.
Absolutely. This demonstrates how seasoned technical analysts don't just look at patterns in isolation. They integrate them with crucial external factors, highlighting that for a high-growth, regulated industry like deep-sea mining, technical predictions are often contingent on real-world policy and environmental developments. So, in essence, the waves might be telling us one thing, but the overarching tide of regulation and public acceptance could easily override it.
Right.
It's a reminder that even the most precise technical analysis needs real-world catalysts to truly shine.
That's a powerful way to bridge the technical with the fundamental. But beyond professional analysts and sophisticated trading methods, what about the voice of the crowd? The retail investor sentiment.
The retail pulse.
After all, that collective actions can have a real impact, particularly on a stock like TMC. The report touches on community sentiment, noting that TMC has 23,119 watchers on StockTwits, with mentioned volume recently up 8%.
23,000 watchers.
Yeah.
That's quite a following.
For those unfamiliar, what exactly is StockTwits, and why are these numbers relevant indicators of the retail investor pulse? What can they tell us about how individual investors are feeling and acting?
StockTwits is essentially a real-time social media platform specifically designed for investors and traders. Think of it as Twitter for stocks, where users share ideas, discuss market trends, and react to news in short, focused messages called hashtags.
Okay.
The number of watchers on StockTwits for a particular ticker indicates the level of general interest and attention a stock is receiving among individual or resale investors. 23,119 watchers is a significant number. It suggests that TMC is very much on the radar of a large and active retail trading community.
It's not flying under the radar.
Definitely not. This isn't a niche stock known only to a few. It has broad appeal. When mentioned volume recently up 8%, it means there's been a noticeable increase in conversations and discussions about TMC on the platform. This surge in discussion can often precede or accompany price movements as retail traders react to news, share technical analysis, or collectively focus their attention and capital on a stock.
So increased chatter can mean increased volatility.
It can, yeah. It's a surprisingly effective barometer of growing engagement and can sometimes signal increased volatility as more retail capital flows in or out, depending on the sentiment. For you, it's a quick way to gauge the collective temperature of a significant portion of the market participants.
Despite the increased chatter, retail sentiment itself appears quite cautious, even bearish. The report indicates a prevailing sell bias at 58% versus buy at 42% among StockTwits users, explicitly reflecting caution.
A 58% sell bias.
Yeah, that's cautious. How does this immediate crowdsourced sentiment align with everything we've discussed so far, from the technical breakdown to the regulatory hurdles?
This sell bias among retail investors, with 58% leaning towards selling or caution compared to 42% buying, directly reflects the pervasive caution and uncertainty we've been dissecting throughout this deep dive. It aligns perfectly with the double top breakdown signal, which, as we discussed, triggers a strong bearish sentiment and suggests further downside.
Makes sense?
It also logically reflects the inherent risks of a pioneering industry facing significant and unresolved regulatory hurdles, coupled with a vocal environmental opposition. Individual investors, who often have less access to deep institutional research or real-time fundamental insights beyond the headlines, tend to be more susceptible to immediate price action and headline news.
Reacting to the chart and news flow.
Exactly. So a prevailing bearish or cautious sentiment among them is a natural reaction to a stock that has experienced a technical breakdown and operates in such an unpredictable external environment. While retail sentiment isn't always predictive of long-term trends, it can certainly contribute to short-term price movements and reflect the immediate market psychology. It means a significant portion of the retail crowd is either actively selling or holding back from buying, which can put continued downward pressure on the stock, or at least prevent a rapid rebound. It's the pulse of the individual investor, and right now, that pulse is indicating apprehension.
And going a step further into broader public discourse, the report mentions that Reddit's deep sea mining community hosts active debates on permitting and ESG impact.
Reddit. Always active debates there.
Can you explain what ESG is in this context and how these online community discussions offer a qualitative, unfiltered insight into the broader challenges and ethical considerations facing TMC?
Sure. ESG stands for environmental, social, and governance factors. For the curious learner, think of it as a company's report card on how responsibly it operates, not just financially. It's about looking beyond the bottom line to understand a company's impact on the world.
More than just profits.
Much more. For deep-sea mining, the E for environmental is, as you can imagine, absolutely paramount. It covers concerns about biodiversity loss, ecosystem disruption, the potential for sediment plumes, and the long-term impact of mining on the planet's largest habitat. The S for social touches upon issues like the rights of indigenous communities, potential impacts on global food chains, fisheries, and the broader societal acceptance of such resource extraction. And G for governance deals with transparent, ethical corporate practices and how the company is managed.
Got it. E, S, and G.
Reddit's deep-sea mining community serves as a vibrant, often unfiltered forum where the public and various stakeholders can openly debate these incredibly complex issues. These discussions, particularly concerning permitting, the regulatory approvals, and ESG impact, offer a qualitative insight that goes beyond just financial numbers or technical charts.
Real people talking about real concerns.
Exactly.
Yeah.
You'll find passionate arguments from environmental activists, discussions among those optimistic about the critical mineral potential for the green transition, and debates about the ethical implications of pioneering this industry. This community reflects the broader public and investor discussions, delving into the ethical and practical implications of the industry. It's a crucial pulse check on the social license to operate for companies like TMC, revealing the diverse perspectives and real-world concerns that shape the narrative around a company beyond just its financial performance. This is where the human element of investment and industry development truly comes alive, and it's a critical input for any long-term investor in this space.
It truly shows the multifaceted nature of this investment, underscoring that it's not just about the charts or the balance sheet, but the broader societal and environmental context. So let's tie all of these threads together as we look at the outlook and risk summary for the metals company, synthesizing all these complex factors. The report highlights a delicate, almost paradoxical balance for TMC. strong capital at hand, and strategic backing from Korea Zinc support midterm growth.
The positives.
However, it immediately counterbalances this, stating that deep-sea mining permits, regulatory timing, and environmental opposition pose execution risks.
And the big negatives.
This really summarizes the central tension, doesn't it? The push and pull that will determine TMC's future.
Absolutely. This statement perfectly encapsulates the core existential challenge facing the metals company. On one side, TMC possesses robust financial strength, buoyed by those significant capital raises, specifically the $122.2 million fresh injection, and, crucially, the strategic partnership with Korea Zinc.
Financial muscle.
Exactly. This financial muscle provides a solid foundation and ample runway for its midterm growth, allowing it to continue its extensive research and development programs, invest in advanced technology, and sustain its operational footprint without immediate financial distress. This is a considerable advantage for any pioneering company in a capital-intensive sector.
A strong footing.
Yet on the other side, that growth potential is severely constrained and held hostage by formidable external execution risks. These aren't internal operational failures or poor management decisions. They are fundamental external hurdles tied to the industry's very existence.
Factors outside their control.
Largely outside their control, yes. The unpredictable nature of gaining definitive regulatory approvals from bodies like the International Seabed Authority, the uncertain timing of when these crucial permits might materialize, and the persistent, powerful pressure from environmental groups calling for moratoriums are all factors that TMC cannot fully control. These are the powerful headwinds that fundamentally determine whether TMC can successfully transition from an exploration and development company to a revenue-generating commercial-scale entity.
Okay.
For you, it means understanding that even with strong financials and solid strategic backing, the company's ultimate future is largely dictated by factors beyond its immediate operational control, creating a unique and high-stakes investment profile. It's a compelling example of how broader global forces can trump even the best corporate strategy.
Given these inherent risks, particularly the external ones, the report wisely advises investors to leverage any further pullback as a structured re-entry opportunity.
Potential buying opportunity is structured correctly.
What does this disciplined approach entail for an investor who believes in the long-term vision of deep-sea mining and is eyeing TMC? It sounds like it's about patience and strategy, not panic.
This advice absolutely emphasizes a disciplined, long-term approach, rather than reactive, impulsive trading driven by fear. Leverage any further pullback means that for those looking to build a position in TMC, price dips should not necessarily be seen as alarming events that signal a need to exit.
Don't sell the dip just because it dipped.
Exactly. Instead, they should be viewed as potential buying opportunities, especially if you believe deeply in the long-term vision of deep-sea mining and TMC's pioneering role within it. The key here is structured re-entry. This ties directly back to the specific methodical entry strategies outlined by Jin Log, earlier purchasing at predefined price levels like $6.24 or $3.50, and only when confirming technical signals such as rhythm stabilization, flow confirmation, or institutional flow acceleration are present.
Using those entry triggers we discussed.
Precisely. It implies a methodical, pre-planned accumulation strategy, not impulsive buying based on emotion or chasing a sudden rally. It's about building a position strategically, spreading risk over time, and taking advantage of market adjustments, rather than reacting to short-term volatility or succumbing to the emotional swings of the market.
Right.
It's a blueprint for patient, conviction-based investing in a high-risk, high-reward sector.
And finally, looking ahead, beyond the immediate charts and financials, what are the absolute key monitoring points for the future of the metals company? The report advises continuing monitoring permit milestones and ESG developments. Why are these two factors in particular paramount for TMC's long-term success, perhaps even more so than traditional quarterly earnings?
These are arguably the most critical external factors that will dictate TMC's long-term success, potentially even more so than traditional quarterly earnings in the immediate future for a pre-revenue company. Permit milestones refers to any progress, announcements, or definitive approvals from regulatory bodies, particularly the International Seabed Authority.
Any news from the IS?
Any news, yes. Any clarity, even partial, on the regulatory framework for deep-sea mining, whether it's a decision to move forward or even a clear roadmap for future decisions, would be a huge, transformative catalyst for TMC, allowing them to move closer to commercial operations and attract further investment. Without clear permits, all their technology and capital remain largely theoretical.
Stuck in limbo without permits.
Exactly. Similarly, ESG developments encompass a wide range of factors. Shifts in public opinion regarding deep-sea mining, the publication of new scientific studies on deep-sea impacts that could either validate or invalidate environmental concerns, evolving corporate sustainability practices within the industry, and the ongoing dialogue with environmental groups and international bodies.
The whole ESG picture.
The whole picture.
Hmm.
For TMC, these ESG factors are fundamental because they determine the company's social license to operate, whether the world, at large, will accept and allow this industry to flourish. Without clear permits and a degree of public and institutional acceptance, the extensive capital invested and the technological advancements will remain largely unutilized.
Okay. For you, these are the fundamental overarching drivers that will truly influence the future direction of the metals company and, indeed, the entire deep-sea mining sector. They represent the high-stakes game being played out beyond the daily stock chart, determining whether this innovative yet controversial industry can move from aspiration to reality. #outro. So what does this all mean for you, the curious learner? We've just spent time unpacking how a single company, the metals company, encapsulates a dizzying array of sophisticated financial analysis, cutting-edge technology, complex global regulatory hurdles, and profound environmental ethics.
It's quite the mix.
It's a powerful microcosm of the immense challenges and thrilling opportunities inherent in bringing entirely new industries to life, especially those touching upon our planet's last frontiers.
This raises an important question. In a world where pioneering industries, driven by the demand for critical resources, often clash head-on with deeply held environmental values and the intricate mechanisms of global governance, how do we, as informed individuals, critically weigh the potential economic benefits against the immense ecological risks?
That's the core tension, isn't it?
It really is. The metals company's ongoing journey, navigating these powerful currents of innovation, finance, regulation, and environmental concern, could very well serve as a vital case study for how these tensions might play out on a global scale in the coming decades, offering a compelling window into the future of resource extraction and sustainability. It's a conversation that will only grow louder.
That's a powerful thought to leave you with, and certainly a lot to ponder. Whether you're looking at the charts or the deeper implications for our planet, TMC is unquestionably a company to keep on your radar. Until next time, keep digging for knowledge and stay well informed.